This is the first of a three-part series on the money market. In this section, we'll be talking about the type of institutions that populate the money market, especially focusing on financial intermediaries. In the next section, we'll consider the factors that affect the interest rates that banks and other lending institutions charge their customers. In the third section, we'll hook up the money market to the circular flow, identifying the flows both from the system out to the money market and from the money market back into the system. You are already familiar with our basic circular flow model. Here it is without the government and the foreign sectors, which were added in the previous lessons. But now we're going to add another sector, the financial sector. So we'll call this box MM to represent the money market. You'll see why we give it that name later. So far, our circular flow model shows that there are only two things that the household can do with their income. They can spend it. As you can see, that this flow highlighted in green from the household to the firm obviously represents consumer expenditures, and they can pay taxes with it. This flow, highlighted in red, you may recall, represents taxes flowing from the household to the government. But there's a third thing that the household can do with their income. They can save it. And that's why we need a money market in our circular flow diagram to show where the savings go. But before anything else, we need some definitions. As I mentioned earlier in the semester, economics uses words that are common, everyday words, but they have a special meaning for analytical purposes. Words such as land, labor, demand, and costs are a few examples. If you tried to use the everyday English definition of these words in economic analysis, it wouldn't work. Now, here are two more examples that you must make a conscious effort to use in the economic analysis context. The two words are savings and investment. Savings, in this context, is defined as anything that the household does with its disposable income or after-tax income other than buy a consumer good with it. That means that if the household stuffs cash in a mattress or a pillowcase, it is saving. If the household deposits money into a bank account, it is savings. If the household buys stocks or bonds, it is savings. Now, it is spending money to buy stocks and bonds, but stocks and bonds are not consumer goods. And so therefore, the household is savings. Now, in everyday language, we'd call this investing. But in macroeconomics, technically, it is savings. So, what we would ordinarily call personal investing in macroeconomics is savings. Investment for macroeconomic analysis is defined to mean the purchase of capital goods by firms. In everyday English, this might be called business investment, but in macro, we'll just refer to it as investment. So again, personal investment, such as buying stocks, mutual funds, and the like, in macroeconomics is called savings. Business investment, a firm buying capital goods, is called investment. You and I buy widgets, that's consumer spending. A firm buys widget-making machines, that's investment. Now that we have those definitions out of the way, let's identify what kind of entities populate the money market. As you can see, there are all sorts of firms in the financial sector that populate the money market. There are banks, savings and loan institutions, credit unions, the stock market, bond markets, mutual fund companies, even insurance companies. We can just summarize this list by saying all financial intermediaries. And we'll talk about what that is in just a second. And we can divide it into two types: depository institutions and non-depository institutions. The depository institutions include things like banks, credit unions, and savings and loan institutions, where you can go and deposit your savings and they'll hold it for you and either pay you interest or provide checking services. The non-depository institutions are firms that will help you buy stocks and bonds, like mutual fund companies, companies that will provide you with brokerage services. There are companies that will invest your money for you and pay your heirs if you die. These, of course, are insurance companies. There are other companies that will provide you with financial advice and provide other financial services. So, what is a financial intermediary? The root word of intermediary is, of course, intermediate, which means in the middle. So an intermediary is a middleman. Although we often speak of middlemen in a pejorative or negative or cynical manner, like if it wasn't for the middleman, prices would be a lot lower, but the middleman has to get his cut and he's skimming off all the profits for himself. These high prices are caused by the middleman. But actually, the middleman plays an important role in a capitalist society. A middleman actually does make a productive contribution to society. The middleman brings together buyers and sellers. For most consumer purchases, we don't need a middleman. When I want a loaf of bread or a bottle of wine, I just go to the grocery store or the liquor store. We don't need a middleman for those kind of purchases. But for items that cannot conveniently be stored on the shelves of a retail establishment, we may indeed need a middleman. For example, if you wanted to buy a house, how would you find a house to buy? Well, of course, you could ride around town all day and look for houses with a for sale sign in the front yard, or you might see an ad in the paper or something like that. But even if you were to spot one that you liked, how would you go about buying it? What would you do? Go up to the front door and say, "Hey, I'd like to buy your house. Here's $400K. Is that okay?" Obviously, you could use the internet to locate and view a house for sale, even its interior. The internet makes information more readily available to people and has thereby diminished the need, in many cases, for the services of a middleman. But buying a house is a long, involved process requiring legal advice, transaction taxes, recording fees, and a whole bunch of other things that you need to be informed about. And you might not have the time or the ability to do it all yourself. It might be much quicker, easier, and cheaper to use the services of a middleman. Now, another word for a middleman is a broker. So in this case, you would want to use a real estate broker to help you. The broker could deal with the attorneys, the bureaucrats, the sellers who are deeply offended by your lowball offer. Don't you realize these people raised their kids in this house? Or you're not respecting the fact that this is where we had our last Thanksgiving dinner while Grandpa was still alive. The owners are always going to overvalue the house and will resent you for not doing the same. All of these things are very unpleasant. I find it better to let the broker deal with all that. In my long history of buying and selling houses, I find that because I only do it once every 10 years or so, I'm very inefficient and for the most part ignorant of everything that needs to be done. I find it much better to use the services of a middleman. Or, if you wanted to sell a house, the middleman could find you a buyer pretty quickly, much sooner than you could on your own, and do all the rest of that stuff as well. Another asset that you might want to buy, for which you would need a middleman or a broker, would be stocks. A share of stock represents a piece of ownership in a corporation, and it's a great way to put your money to work for you. Suppose I wanted to buy 100 shares of stock in Apple Corporation. Where would I get it from? I can't buy it from Apple. They've already sold it all. I'm going to have to buy it from someone who currently owns it and is willing to sell it at a price that I'm willing to pay. But who would this be? I have no idea. Maybe I could go to the phone book, start with the A's, and continue to make calls asking people if they had some Apple stock for sale. Hypothetically, I'd eventually find somebody after making thousands of calls, but how much time would this take? What would be the opportunity cost? What would my phone bill look like? Obviously, it would be much quicker, easier, and cheaper for me to employ the services of an intermediary, a middleman, and in this case, a stockbroker. Although I'd have to pay him a commission, as I would a real estate broker, it would be worth it. And it would be the same situation if I wanted to sell some stock. I wouldn't have to knock on doors or go through the phone book. If I used the services of a stockbroker, I could find a buyer within seconds. A long time ago, I wanted to buy my daughter a new car for college, but rather than trade in the old jalopy she was using to get back and forth to high school, I thought I'd get a better deal by selling it myself. But despite my best efforts to sell that car, after several months and lots of time and money wasted, I finally decided to sell it to a used car salesman. He would, in essence, be a middleman. That car would eventually be sold, but I wouldn't have to wait to get my money, and I could dispense with all the stress and all the costs. So he came out to my house, offered me way below what I thought I could get on my own, but I took it out of desperation. Turns out, I contacted him the next day, and he had already sold it, and for exactly the amount that I had anticipated. What makes a middleman so much better at finding a counterparty than a rank amateur such as myself? One thing, of course, is his knowledge of the market. The used car market, for example, was this guy's specialty. He knew the ins and outs of the market, he had lots of experience, and he knew all the pitfalls, the shortcuts, and the efficiencies. But there's another very important reason. The other reason is that he keeps an inventory. A potential seller knows that by going to the middleman, he is able to sell the item quickly and inexpensively. Because if the middleman doesn't know of a potential buyer, he'll buy the good himself and just put it in his inventory. And the potential buyer of an item knows that by going to the middleman, he is able to quickly and conveniently see the array of items available in the middleman's inventory without having to search all over town for them himself. But what about a financial intermediary? Whom does a financial intermediary bring together? We are so lucky to be living in a capitalist economy. A capitalist economy is the only type of economy in which individuals can put their money to work for them. Look at the guy at the bottom. He's grunting and sweating, precisely what you come to college to avoid. The guy on top is smiling. He's letting his money work for him. And one day, when you get too old to work, you'll want to have your money working for you as well. Now, there are many ways in which an individual can put his money to work for him. And if you want to find out what these are, let me suggest that you take a course in personal finance. You'll find out a little bit more about that in the third video in this series, where we hook up the money market to the circular flow. But I can tell you now that the most frequently used method of putting one's money to work is to lend it out. When you lend money to someone, you are providing a service that is of value to the borrower and for which the borrower is willing to pay. The service that the lender provides the borrower is allowing the borrower to consume something now rather than making him wait until he saves up enough cash to buy it. It's just like an apartment. The borrower is essentially renting the cash from the lender, and the rent that the borrower pays for this service is called interest. Suppose you wanted to buy this car. How long would it take you to save up the $60,000 to buy it? Would you pay money to have it now rather than having to wait until some indeterminate point in the future? If not, my guess is you'd be walking for the next 4 or 5, maybe even 10 years. Or how about this house? How long would it take you to save up the $800K to pay for it? Holy mackerel, you couldn't live in this house until you were 100 years old, unless you could find someone to rent you some cash so you could buy it now. So, if you had a shortage of funds, where would you find a lender? Would you knock on doors? Would you use the phone book? Who the heck would lend you money? Or, if you have a surplus of funds and you wanted to put it to work, how would you find a reliable borrower? And by reliable, I mean one that would pay you your money back when it was due and pay you your interest on time. Rather than trying to find this person yourself, it would be far cheaper, far quicker, much more convenient, much less stressful to use the services of a middleman, an intermediary, and in this case, a financial intermediary, a middleman who brings together someone with a surplus of funds that they want to put to work and someone with a shortage of funds for which they would be willing to rent so that they could buy something now rather than having to wait. Although there are many types of financial institutions that populate the money market, this is exactly what a depository institution does. But what makes such an institution so much better than you at finding a lender if you have a shortage of funds or a borrower if you want to put some surplus cash to work? Well, you are exactly right. I'm sure you know. It is that they keep an inventory. And what is it that comprises the inventory of a depository institution? It is, of course, money. But how does this financial institution, we'll just call it a bank, how does the bank acquire its inventory so necessary to be a successful middleman? A bank acquires its inventory in 2 basic ways. First, it pays you for it. This is why a bank pays interest on a savings account. It is paying you to deposit money into their vaults. Now, when I was about 14, I learned a lesson about banks. My father saw that I had some small amount of money, maybe $16, which would actually probably be worth about $100 today, floating around in my sock drawer. He suggested that rather than floating around loosely like that, I deposit it in a bank. And there it would be kept in a nice, thick, burglar-proof vault. I thought about it for a second and said, well, you know what, that sounds like a good idea. How much would they charge me for that service? And he said, charge you? They won't charge you, they'll pay you. Now, he didn't explain why, and I really didn't care. But that sure got my attention, and I figured this had to be the best deal in the world. Now, the other way in which a bank can acquire its inventory is by providing checking services. A check is simply a set of instructions that tells a bank to take money out of your account and either hand it to someone or put it in their account. Now we'll talk more about checks when we get to Module 10 on money, banking, and monetary policy. But your next step is to watch the second video in this series where we consider the factors that determine the interest rate that a bank will charge a borrower.